Welcome everyone to QB Power Hour. Today is August 10th, 2017, and this is a re-recording of the live event we had at 12 p.m. Eastern today. Our webinar crashed in the middle of the presentation, so we lost the recording. So Kirk and I sat down in the middle of the night with peace and quiet and re-recorded this whole thing. There will not be the same polling questions and Q&A as in the live training, but I will bring some of the Q&A from the most commonly asked questions for Kirk. Anyway, today's episode is deep dive into pricing options for accounting services. We'll speak briefly about QB Power Hour, and the topics for today are twofold. We'll learn some of the essential value pricing concepts in the context of pricing or giving clients prices, and then we'll understand why the client at the end, they want choices and they want quote unquote control over their accounting services, and how we as the accountants can manage that control a little bit and use it to both get a little bit better profits from our perspective and give the client the choice that they want. So QB Power Hour is basically a webinar series every other week. Next episode will be August 24th. Then I'll skip to November 7th. And then November 21st, we will have a skipping week there because of tax season. Generally, we cover QuickBooks Online and QuickBooks Desktop topics, pretty leveled 50-50. And from time to time, we'll do practice management topics as this specific one is a practice management topic on pricing options. Michelle Long is not with us today as she was traveling for training. She's the owner of Long for Success, co-host of QB Power Hour, author of 5 books. Check her out on Amazon.com. She's also the LinkedIn group manager for Successful QuickBooks Consultants, which has over 160,000 members, and the co-host of the Accounting VCon. Myself, my name is Hector Garcia. I live and work in the Miami area. I teach QuickBooks in my own classroom and also have a private accounting practice or my own accounting practice. There's my email, Hector Garcia CPA, and my Twitter handle. I'm pretty good at answering emails where people contact me with QuickBooks questions, accounting questions, what have you. Some of the upcoming events that we recommend is Michelle Long's Accounting VCon, which will be September 21st and 22nd. It's a virtual conference. It's online, and so check it out at accountingvcon.com. There's also the Art of Value Conference. First time we ever talk about this in QB Power Hour because of our guest, Kirk, who's actually the creator of that conference. And that's going to be in Allen, Texas, November 8th to the 9th. And it's all about creating value, value pricing, and those sort of topics. Then there's the biggest event, or QuickBooks-related event of the year, QuickBooks Connect in San Jose, California, November 15th to the 17th. Both Michelle and I will be there. Possibly Kirk will be there. I don't know what his schedule looks like. But feel free to say hi to us if you go to the conference. And the next year, Scaling New Heights in Atlanta, Georgia, June 17th to June 20th. Now, this is a CPE webinar. You can only earn CPE while you watch it live. And since this particular recording is not the live, so we won't get into too much detail about that, but go to qbpowerhour.com to register for the live webinars and earn your CPEs. We thank our sponsors, T-Sheets, #1 rated app in the apps.com Intuit ecosystem, create, manage, and approve timesheets from any device. Arrow Workflow, the only workflow tool designed by pro advisors for pro advisors. It fully integrates with QuickBooks Online. And HubDoc, the most popular document aggregation tool for QuickBooks Power users, automate your document management and retrieval of documents from your bank directly. Now, let me start the content by just really quick 4 points on some of the value pricing fundamentals that you actually learn over time as you start unraveling all the different concepts of value pricing. These are the 4 things I've learned through my practice. #1, giving a fixed price isn't always value price. So just because you give a fixed price doesn't necessarily mean you're value pricing. In many cases, I see accounting professionals put a public price on their website and even with options, but it's the public price that is for everyone. And by definition, if you're not attaching your services to what your customers value, or you're not pricing the customer, it's technically not value price. Now, there are some components of value price on fixed pricing and options, but you have to actually understand what the client values, what's important to them before you can give a price and truly call it value price. Now, menu pricing is also not necessarily value pricing. This is where all your potential services are broken down into little items, reconcile one bank account, reconcile two bank accounts, whatever happens to be, and you put a price tag on each one. Now, that's menu style. That works great in restaurants. And yes, the customer can pick more and pay more, but at the same time doesn't specifically speak to how much they value the end result of what you want. Value billing in arrears is also by definition not value pricing. Many folks take on an engagement, they have a high level of trust with their customers, they don't bill by the hour, and they say, oh, I'm value pricing. But if you don't give a price up front, if you don't actually exchange a price for a signed agreement, it doesn't have to be signed agreement, verbal agreement works well, but if you don't give a price up front in exchange for a scope or some sort of result or guaranteed result or understood result, then it wouldn't be value pricing. Now, I'm a culprit of that. I have many clients in which in the middle of tax season, things are moving really, really fast, and I don't have time to price every single thing. So we end up just doing the work and billing it afterwards. And that's wrong. That's not value pricing. So I understand that people do it. I just want to make sure that you don't confuse the two and think, okay, I did it, I value priced it. And no, by definition, if you're not given the price up front, if you're pricing in arrears, it wouldn't be value pricing. Now, the other thing that I understood over time is that true value pricing should always be good for your customers. So if you price something and the customers perceive value of that service, it's at the same of the price or possibly higher, then you're value pricing. That means the customer is getting the value for the price. That doesn't always translate to profits for the accountant. It is possible that you're dealing with a customer that doesn't understand the value. Maybe I blame it back to the accountant. You don't know how to communicate the value, or maybe you didn't understand what their true needs were. And true, there are some customers that are just not good customers. And what can you do? Bad customers, get rid of them and move on. But don't try to make every customer fit into your model. If the customer cannot value, or you cannot find ways to add value enough so they pay for that, they pay for that price willingly and happily, then they're just not the right fit. So those are just quick things that I learned on that. And I wanted to give it up to Kirk so he can talk about his presentation on pricing options. So Kirk, I'm going to go ahead and pass you the baton so you can share your screen.
Hi, everyone. Thanks for watching this recording. The title of this session is Pricing Options for Accounting Services. And I guess there's two ways you could take that title. You could say, okay, we're pricing options, as in setting a price for options, or the type of options we're creating are around price. And that's really what we're talking about here, is how do you offer the customer choices? And I want to walk through an example that'll help illustrate why choices are important for the customer. This is a subscription form that was used by Economist magazine a few years ago. In fact, this is one of the examples that's used by Dan Ariely in his book, Predictably Irrational. It's a little hard to read, but the first option is for a print subscription for 1 year to The Economist for $59. I'm sorry, the first option is an online subscription for $59. The second option is a print subscription for 12 months for $125. And then the third option is for both the print and web subscription for $125. So we have the first option at $59, and then options 2 and 3 are at the same price. Now, you would think, looking at this, that they made a mistake. Why would you offer two options at the same price? And Dan Ariely, when he saw this, he had the very same question. So he actually called up Economist magazine and said, hey, what's going on here? Well, he got passed around from one person to another and basically determined they didn't realize they had done this. It was an accident. But Dan asked the question, well, how would customers make a selection when they have 3 options versus 2? He's a college professor, and so what he did is he gave that subscription form to 100 students with all 3 options. If you look in the middle column, you'll see that 16 students chose the online version and 84 students chose the print and web. Nobody chose print only because it was the same price. If you look at the right-hand column, there are 2 options. And this time, the online option was selected 68% of the time versus the print and web 32% of the time. The only difference between these two is simply the presence or lack of the middle option. What this illustrates is customers really don't know what the value of something is. And in order for them to be able to attribute value to something, they need to be able to make comparisons. And so when you offer the customer choices, when you offer them three prices, you're actually helping them decide what is valuable to them. And so you're actually making it easier for them to make a better buying decision when you offer them options. Not only did it help select options in this case, but it also contributed to higher revenue. If you look at the revenue for the subscription form with three options, you can see that it was almost $11,500 versus two options was roughly $8,000. So about a 33% difference. That's an illustration of not only how options help the customer make a decision, but how options are more profitable for the professional. Steve Major, who is an accounting professional from Australia, was a guest on my podcast, and he said something that I think is really key. Value pricing can change your business. Value pricing plus options can change your life. What Steve really is illustrating here is if you want to get the maximum benefit from value pricing, you need to do it with options, because without options, it doesn't have the same dramatic effect. I was working with one accounting professional named Chris Farman, who's from Florida, and he works with craft breweries. And one of the things I was able to help him do was increase the amount of revenue on a particular proposal, which normally would have been about $16,000. His customer actually wound up selecting $30,000. So he got $14,000 more dollars in revenue just by offering options. When you boil it down, options has an impact on the customer's mindset. When you offer them only one choice, take it or leave it, yes or no, the question they're trying to answer is, will I work with you? It's essentially an ultimatum. But when you offer them choices, that question changes to, how will I work with you? It's a subtle shift. The customer doesn't even realize it happens, but in their mind, they go from trying to decide, are they going to hire you, to how are they going to hire you? And obviously that shift has a positive impact. It should increase your closure rate. Now, when I talk about value pricing on my podcast, our slogan is discover value, create options, and start pricing. Discover value is the first pillar, and creating options is the second. Now, I've got a whole nother session that I do on having that conversation where you discover value, but I want to cover a few key points before I get into options. Again, it's a value conversation or a why conversation, and the root of it is from this diagram. We're all in the accounting profession, so we understand basic math, that the price the customer pays less your cost is your profit. But what we lose sight of is the customer's profit. Whatever the value created for the customer, when you subtract the price they pay, that's their value. And on this particular graph, that's represented by the gold bar. And you can see that on this graph, the customer's profit is twice your profit. And you at least want it to be a double, if not three or higher multiple. Now, there are three key questions that I think you can ask to help discover value from the customer's perspective. And I'm going to give these to you very briefly. The first one is, why now? There is a reason that the customer is seeking this particular solution right now. There's a reason that 6 months ago was not the right time, or waiting another 6 months is not the right time. Why are they doing this now? That's the first question you want to get an answer to. The second one is, why this? Now, this gets into the idea that a lot of times when customers come to us, they have self-diagnosed what is going on. They've essentially written their own prescription as well. Now, if a doctor writes a prescription without first doing proper diagnosis, that's malpractice. And so what we have to do is help our customers. We have to help prevent our customers committing malpractice on their own behalf. And that's why this question is so important. You want to ask, why this? Why do they think this is the solution? Don't just accept their own diagnosis, but perform your own. And then the third question is, why me? You could think of this as a marketing question. The answers to this might be, well, you're the expert. I've read your blog. I've seen you speak. I've read your book. It could be, well, you're local to me, or another variety of reasons. It might be a referral, but understanding how they value you is also part of the equation. So that's a quick rundown on discovering value, but let's spend the rest of our time talking about the second pillar, which is creating options. I've already explained with the economist example why offering options is so important. It actually helps the customer make decisions, and it will typically increase your revenue. There is a magic power in three. Think about Starbucks. When you go in, you can buy your coffee either tall, grande, or venti. If you go through a drive-through at a fast food place, a lot of times if you're going to order one of the value meals, they're going to ask you, do you want that small, medium, and large? Airlines do this. When you fly on international flights, you can buy a coach seat, a business class, or even a first class seat. So the power of three is used all over the place. And if you start paying attention, you'll notice it. There's a reason you want to stick with three. 4 is too many, 2 is too few, 3 is just the right number. What I want to give you is 7 categories that you can think about as you're creating options for your customers. Each of these categories begins with a letter T, and so I call this the 7 T's. I'm going to walk you through each one, and then we're actually going to look at some pricing options that Hector created for one of his customers and kind of break those down in these categories. The first one is tailoring or customization. This is the one where in professional services, I think you have the most opportunity to do something unique for each customer. And that's really what this boils down to. You're looking for how can you customize the services that you're providing to your customer in ways that increase the perceived value to them and allow you to set a higher price as a result. Think about an athlete who needs to get a custom tailored suit. They can't go in the store and buy one. They've got to go to someone who makes custom suits. We're doing the very same thing, just with accounting services. Second T is talent. There are a couple of different ways that I think about this. Number one, if you have a firm with more than one person, it could be, well, who does the customer get to interact with? Is it the senior accountant or the junior accountant? Is it the bookkeeper with 10 years experience or the bookkeeping intern during the summer? That's one way to think about talent. Another way to think about talent is what access does the customer have to that particular individual? Will you answer emails, and how quickly will you do it? Can they text you? Can they call you? Could you have a customer use your mobile phone to contact you on a weekend? I have a colleague down in Australia who's an attorney, and he was able to charge 5 figures strictly because a customer had his mobile phone and they had an agreement that if the customer called, he would answer anytime, 7 days a week, 24 hours a day. This particular customer had to acquire a business. He didn't know exactly how many times he'd need to talk with his attorney. And so basically, he put the attorney on speed dial. The customer only used that option one time, but the advice he got was worth the price he paid. So that's kind of one way that talent can be used. Third C is technology. We hear a lot about technology in the accounting space, particularly the technology that we're all familiar with is QuickBooks, either the desktop or online version. And so one way you can use technology is simply decide, do you prefer to work with online or desktop, and structure your options in a way so that it helps incentivize the customer to work with the technology that A, you either think is best for them, or B, you prefer. So for example, I would think that you really want to get your customers to move to the cloud. You want them in the online version because it makes accessing their books easier. You don't have to worry about, do they have the right version? Do they have installed patches? What about conflicts with operating systems? All that kind of thing. So you could, for example, charge less to work with the online version and charge more to work with the desktop version. Another way is consider what add-ons that you could use with QuickBooks, things like Receipt Bank and other types of apps that can extend the QuickBooks ecosystem for them, particularly if you're number one, showing them how to use that, taking care of the integration, and also helping uh, cover those charges as part of whatever price you're charging the customer. The fourth T is terms, and payment terms specifically is what we're talking about. Now, probably the most common example of payment terms that I see in accounting and bookkeeping is you agree to say, a yearly figure. Let's just use, $6,000 as an easy number. And so the customer is going to divide that by 12 and pay you $500 ideally at the beginning of every month using some type of auto draft or credit card. That's one way. Another way you can use payment terms is say, well, we will allow you to pay that monthly, but if you pay us quarterly in advance, we'll actually offer you a slightly lower price. So maybe you offer them a price of $5,500 if they will pay it quarterly in advance. You can also consider forms of payment as part of this. Do you accept check, credit card, bank draft, etc.? You can get really creative with payment terms, particularly when you're offering bundles and packages of services that it's hard for customers to get easily elsewhere. The fifth T is time frame. This is timing. The company that I think about with timing is FedEx. FedEx taught us that they're the company to go to when you absolutely positively have to get it there overnight. If you've ever shipped anything with FedEx, you know that they will charge you an arm or a leg to get it there the next day. In fact, they were smart enough to realize they could create two options for next day. They'll get it to your recipient by 8 a.m. the next day or just sometime in the afternoon. Here is the thing that you need to realize is a lot of times the packages that get there at 8 a.m. are on the same truck as the packages that get there in the afternoon. FedEx is actually incurring increased costs to go back out there and deliver the packages later. But what they've realized is the perceived value to their customers for the 8 a.m. delivery, that price more than covers that. So that's one example of time frame. Another time frame would be a customer comes to you on March 15th and wants you to get their tax return ready by April 15th. And they own two businesses and they have some investments and this, that, and the other. And so it's not a simple type of, 1040 easy situation. Training or education. Now, I actually prefer the word education. The best way to explain that is if you're a parent and you have kids, would you rather have your kids have sex training or sex education? I think we would all agree we want them to have education. There are several ways that you can offer education to customers. You can do it through written material, through videos, such as what Hector has on his YouTube channel. You can offer it through live online training or recorded online webinars or live training. You can offer it in multiple sessions. You can offer it at different levels. There's all kinds of ways you can package education and training, but it's really something to think about, particularly if you can offer training in a way that helps the customer do something that there's really no other way for them to do it. The last T that I'll talk about, I use the word travel, but I think of it broader as expenses. And I actually think the most guilty profession with this would be lawyers because, and it's not so much now, but in the past, they would charge you for every photocopy they had to make, every fax they had to send. They would bill you for mileage. I mean, literally you felt like if they put 2 packets of sugar in their coffee, they were charging you for each one. We call it nickel and diming. You don't want to nickel and dime your customers. Why? Because it cheapens the perception of what they're getting. It actually reduces the perceived value. So let me give you a more current example. Let's say that you have to incur $1,500 in travel expenses to go see a customer each quarter. Okay, that's one quarterly visit. Well, if you're going to charge $4,000 for your services, and you know that with 2 weeks notice, travel is going to be about $1,500. Well, your price per quarter is not $4,000 plus expenses. It is $5,500, including And including all expenses. And if you use that language in a proposal, it actually makes you look more professional, that, this price is inclusive of all expenses. So those are the 7 T's. So let's take a look at an example that Hector gave me. Now, this is actually one that he wrote. And so let's just kind of go through this and let's see if we can kind of pick out some of these different bullet points. Which of the T's are they playing off of? So let's take a look at the basic service. And by the way, you'll notice he's named these basic, premium, and deluxe. Obviously, deluxe in this case is the most expensive, whereas the basic is the least expensive. And by the way, when you offer 3 options like this, it's helpful to present it the way Hector's done in 3 columns, because it makes it easier for the customers to compare. It makes it easy to see what's excluded. And by the way, as human beings, we want what we can't have. And so this actually, when customers can see it visually like this, it helps lead them toward one of the higher options. Statistically, they'll typically pick the middle option. But let's start with the basics. So reports delivered by email. Okay, that's one use of technology. It's also a level of access. All accounting and tax questions via email response within 5 business days. Compare that to the premium, where it says all accounting tax questions via email response within 2 business days. There's a timing element, so there's the timing. Compare that with the deluxe option, all questions via email or phone, same business day. You'll also notice that some things are consistent. So for example, between basic and premium, they both have a 1-hour on-site call to discuss the numbers, but on the deluxe, it's a 1-hour mid-month call to discuss progress. So there's a difference. There's also a difference in timing between basic and premium regarding delivery. By the 15th of the month for basic, by the 10th of the month for premium, by the 7th of the month for the deluxe. The deluxe even includes something that's not in the other 2, which is the 1-hour on-site call to discuss numbers, budget performance, and forecast. In other words, Hector has said there are certain things that I will discuss with a customer on the deluxe option that we won't be able to talk about on premium or basic because it's outside scope. So he's hit on at least 3 or 4 different T's here, and there could be more. So this is a realistic example of how you can use options. And by the way, another one that's implied here, these numbers, the 310, the 525, the 840 are paid monthly. So he set this up so that he's going to get 12 equal payments. So he's using terms. And I know Hector, he's going to make sure that's on some type of auto draft or credit card that's done in advance at the beginning of the month. None of this, the customer hasn't paid me and I've already done the work situation. So there's an example of how those 7 T's, at least 5 of them, apply in this particular situation.
And you mind if I comment on that, Kirk, real quick?
Please.
Yeah. So this particular example, and this is why I sent it to you because I wanted your opinion on it. When I sat down with the customer, the core service, what they wanted in terms of, the financial statements and the delivery of the whole work was very, very, very clear. Like we understood exactly what my role was and what I was going to do. But I almost walked out of this deal because he told me, when I hire an accountant, no matter what, I need a response same day. By the way, this is a very light job. I mean, this is something that takes a couple hours for us to do. It was pretty standard, not that many transactions. But he told me he needed responses the same day, that was a non-negotiable to do responses the same day. So when I was speaking to him at the beginning, I thought, okay, this is going to be a couple $100 job, very simple, very routine. But when he said that, what I did is I framed it where I am going to deliver that option that he wants. And for me, it's not ideal to answer the same day. So I did that and put that on the highest option because I wanted to frame the customer to pay the premium, or the deluxe in this case, to pay the extra for wanting that. And then the customer convinced himself, you know what, I don't really need same day. 2 days is good enough for me. And they ended up going with the premium option, which is what I wanted in the first place. So I used their own needs and value, not I want to say against them, but I used it to frame, that level of service they want has to cost more. And at the end, when they realized that maybe they don't need that, that was just out of spite or whatever was going to the guy's mind, which By the way, I never taken a client on same day response time. I typically put it high enough that if they want it, they pick it. And many a times when they see the difference and it's pretty much the same service, they won't pick the highest one if 2-day response time seems almost as good as 1-day response time. So that's why I wanted to send it to you, because this wasn't a scope issue. This was a response time issue.
Right. This is called an access level agreement or access service agreement. You may have heard those terms before from some of my colleagues at VeriSage. And so definitely agree with your comments that, number one, for the best level of access to you, the customer should be paying a premium, and also use your options and pricing to help steer the customer where you want them to go. And if they are going to choose something that is something you really don't want to provide, them paying a premium price for it is going to help compensate you for doing something that's generally not your preference. Let's take a look at another example. Now, I'm going to use an example that I get this question a lot when I speak to accountants and bookkeepers is, what about QuickBooks conversion or cleanup? And I'm going to contrast this or compare it with something I've done in my software business. Now, I have a custom software development company. And with custom software, the quality that you get out of the project really boils down to the testing that's done at the end. And that's very similar to with QuickBooks conversion or cleanup. You have to ask your customer to go in and look at the books afterwards. You have to make sure the chart of accounts is correct. They know how to put in the entries and so forth. Same thing with software projects. And so we were dealing with this conundrum of, okay, customers want high quality software, but yet they don't want to do the testing. How do we turn that into some type of incentive? How do we put that in a situation where if they want higher quality, they're willing to pay more? What we came up with was something we called user assurance. And it was basically an increased level of quality assess or quality assurance on our part, where we actually did more of the testing for them. We actually hired somebody else to go through an additional level of testing that normally we don't do. The alternative was the customer could do that testing themselves. And the way we framed it was exactly how Hector described on the previous options. The customer paid significantly more for us to hire somebody else to do the testing. One of the things we learned from this, we really thought, okay, we offer that 6 times, one customer out of 6 will select that. We found it was more like 5 out of 6 picked it. They were so concerned about quality, they were willing to pay premium for it. And for a while, we were selling our highest option 5 out of every 6 times, and we had to come up with another option. But we were getting paid well for it. So we talked about options. Let me talk about your options. I'm going to give you 3. First of all, I've got a free email course on options that all you have to do is go to our website and sign up to receive it. That URL is artofvalue.com/email. Just put in your email address and we will start sending you that 7-day email course next Monday. Second, as Hector mentioned earlier, we are hosting the Art of Value conference in Dallas, November 8th and 9th. And we'd love for you to learn more about that by going to artofvalue.com/conference. And third, I'm going to give you my email address. If there's questions that you have about any of the content or the conference, you can email me, kirk@artofvalue.com. With that, I'll turn it back over to Hector.
Thank you, Kirk. And I wrote down, great presentation, by the way. So I wrote down some of the questions that were asked during the live webinars. I'm going to go ahead and ask those. So I have these written down here. Let me just put this slide here with your face and stuff. And by the way, you didn't mention, and I don't think you plugged enough your podcast. Like when I discovered your podcast, which was about 2 years ago, and I think your podcast is about 3 years old, I binge listened the whole first couple episodes. And I've learned so much from Kirk, because it's interesting. Kirk is not an accountant. He's a custom software programmer. And it is so funny and interesting at the same time how your problems are exactly like our problems. You know, the clients come in with this nebulous thought of what the end result is supposed to be, right? They have some sort of idea what they want. Sometimes they give in too much input because they think they know how things work in their software world. Then you have the enormous task of giving a scope that somehow encompasses all the possible glitches that happen along the way. And at the end, the customer wants an end result, and they want to pay. They don't want to pay per hour; they want to pay a flat fee. So it is so interesting that, listening to Kirk and some of his friends that are also software programmers in the show. And by the way, in the podcast, there's a lot of like technical people that started first, and then little by little you see more accountants connect to it, because accountants is one of these a profession that we're just so bad at pricing, and we need to get better. And they get attracted to folks like Kirk and Ron Baker and Mark Wickersham and all the experts in pricing, because it does resonate with a real problem. So I wanted to plug in your podcast itself, because it's absolutely free and it's one of the best learning experiences that I've had. So anyway, Kirk, I wanted to ask you a few of the questions from the webinar. One of the questions was, so somebody says, my customer, it's a plumber, and I want to help them price better as part of my engagement statement. Could I use the same pricing techniques that we use for software programming or accounting for a trade like plumbing?
Certainly. First of all, I want to commend you for actually offering pricing consulting to your customer. That's one way you can certainly help increase the value of the service you offer, by actually helping them price better. But to answer your question about plumbers, I'll use the example of the plumber that I use. I use a company called Ben Franklin Plumbing. You can find them at benfranklinplumbing.com. Whenever they come out, they actually give you 3 options, and every single option is a fixed price. They came out to replace the garbage disposal in my kitchen about a year and a half ago. They offered me 3 different models, and I fell within the statistical curve. I wound up choosing the middle option. You compare that with a plumber who charges hourly, and I'm certainly going to go with a plumber who gives me not only choices, but I know what each of those choices is going to cost me before I ever engage them.
Thank you for that. The other question here, and I get this question a lot, is uh, that it's typically easy to get brand new clients into some sort of value pricing, because we start from scratch. We don't have any bad habits. We don't have to deal with maybe mistakes of our own that we've had by pricing them wrong before. What do you think about transitioning them? Like, what tips do you have in terms of going from an existing engagement that's hourly into a flat fee, fixed engagement that obviously it's value priced?
So I'll give you several bullet points on this. First of all, it is easier to learn value pricing by working with new customers. So start with new customers and get at least a half a dozen new customers under your belt before you start thinking about transitioning your existing customers. My second point would be is realize that when you change your business model, not all customers are going to go with you. Some customers are not comfortable with the reason you're making the change, or they're not comfortable with the new business model. And so be prepared that some customers will leave, but you'll attract a different type of customer, which is the kind of customer you want. Now, how do you transition the ones that you already have that will stay with you? I would start by educating them about the change early. So let's say that you're in July and you're planning to make the switch in January. I would start an email campaign with my customers to let them know the change is coming. I might even offer to do 2 or 3 short webinars where we begin to educate them on why we're doing this. And you don't want to talk about it from your perspective, talk about it from the customer's perspective. What's the value of it to them? Certainty of price, guarantee of service. You're going to give them choices. No more they get a bill after the fact and they're surprised by how much it is. You can keep going down the line and explain that to them. It's also an opportunity for you to have a value conversation with them. And that's another way to frame it, is to say, look, I want to make sure that you're getting way more value out of what we provide than what you're paying us. And the only way I could do that is to understand why it's valuable to you. Not what do you want, but why do you want it?
Okay, thank you for that. The other question was, um, once you give a price, a fixed price for an engagement, and there's a scope change. So we haven't talked about the details of a scope change, characters. I know that has to do with how you document your engagement and stuff. But how often do you think we need to proactively review these engagements to make sure that they're being priced correctly?
So really what you're asking is, how do I handle a scope change? and particularly when it's, quote, out of scope. So I think there's two terms we need to define. The first one is change order, and the second one is change request. The difference is typically with a change order, the customer asks for something new, you do the work, and then you put something in writing and ask them to sign off on it after the fact. It's very similar to you send them an invoice with a number of hours after the fact, and it winds up costing more than they thought it would. Flip that around to a change request. You can't order the customer to do anything, but you can request that they sign off on a new scope and an increased price before it's done. So when something new comes up, you have to have the courage to say, this is outside the scope. The way I'm going to handle this is I'm going to write a change request and I will explain the new scope and give you the new price. By the way, in our proposals, we actually put that in as a guarantee. We call it a price guarantee. We say, for this scope of work, this is a fixed price. If the scope changes, we will notify you in writing and give you a change request with the new scope and price for your approval. So that's how I would handle it, but it starts with the courage of saying this is outside scope.
Perfect, thanks. The other question here is, it was actually more of a comment. Somebody said, I find it difficult to value price with like random customers or random industries that come in. I find it much easier for the ones that fall within my specialty. So what do you think specialization and sort of niche in your practice play? What kind of role does it play in pricing?
It is easier to value price when you're a specialist. When you're perceived as a specialist and an expert and the go-to person, it is easier to charge a premium price because we expect to pay a premium price for somebody that's a specialist. It would be one thing if I was going to hire an accountant to help me with my 1040, just my wife and I, we both have regular jobs, nothing complex. It'd be whole different if I've got investments offshore, both in the Caribbean and the Mediterranean, and also, the Southeast Pacific. Whole different thing. I need a whole different type of accountant. And so there's going to be very few accountants who have experience in all three regions of the world. Now, you may not specialize geographically. You may specialize and I only work with winemakers, or I only work with people who are in manufacturing, or whatever that specialization is. But it is much easier to value price, and customers expect to pay a premium for an expert and a specialist.
Perfect. The other question here is, Kirk, do you have anything against marketing your pricing philosophy in your website? Somebody says, I don't know how to market my pricing philosophy. I'm afraid that by not having some sort of price or price range in my website makes it difficult for customers to maybe decide if they can afford me or if I am within their price range. What are your thoughts about sort of marketing or manifesting your pricing philosophy?
First of all, I don't think you need to market that you're value pricing to your customers. For most of them, that's going to confuse them. They don't know the term. They don't understand the benefits. They don't know why. And so I would not come right out and say that to a customer. What I would say to them is, look, every customer that we work with, we customize our services for you. We give you at least 3 choices, and we're going to have a price according to each of those choices. But those choices are going to come after you and I have had a conversation, so I understand what you want and why you want it. Now, you can find a more marketing way to say that, but that's how I would describe, quote, your pricing philosophy. Now, the second part of the question about prices on a website, if you're going to use pricing to help qualify customers, I think that's fine. So, for example, you might determine that your minimum engagement is $1,500. You don't want to work with any customer who can't pay you at least $1,500 for the first check. Okay, put that on your website if you want to avoid people who are only looking to spend $500. Another way to do that is to offer something called productized services. This is something that, again, we could do a whole session on, but a productized service is something you do repeatedly over and over, and you've done it so much, you can do it quickly, you're really good at it, you feel comfortable putting on the website, hey, for this particular thing, here's the fee. Now, in that sense, you're not value pricing the customer, you are value pricing the service, but you're doing it because for that particular thing, you don't need to have the value conversation, or you don't want to. You just kind of want to say, hey, here's something I can do, here's the price. In those cases, a customer is only going to call you after they've looked at your website and they're comfortable with that price. But that's a unique type of offering. But any of those three comments are things that I would put under that umbrella of marketing and pricing strategy.
Sure. And you mentioned in terms of rolling back before you actually place the options, the value conversation you have with your client contained three fundamental whys. Can you go through them again, just real quick, what the three whys are?
Sure. So we're talking about the three core questions of your why conversation. Number one, why now? Number two, why this? Number three, why me?
And you had a fourth bonus one, which you presented on the live presentation. You mind talking about that one? I actually like that one a lot.
Sure. So the fourth one, or the bonus one, is why not? By that, I mean, if the customer doesn't move forward, what's going to be the impact on their business? Typically, a customer is contacting you either because they're trying to eliminate some point of pain or they're trying to seize some type of opportunity. You need to understand what is the pain that's going to continue or what is the opportunity that's going to be lost if they don't do something. That's what you're seeking with the why not question.
And some people say that some value pricing experts or folks that talk about value pricing specifically say that you should not charge for that value conversation. And some others say that you should charge for the value conversation, setting the statement up front that that conversation itself, it's valuable. What are your thoughts about charging for the initial conversation in which you gather the scope from the client?
I think you've got to think about what is the degree or scope of that conversation. If it's a short phone call, 30-minute, 45-minute phone call that basically would kind of fall under the umbrella of a sales conversation, I certainly wouldn't charge for it. If it's something that's more along the lines of a discovery engagement, or sometimes we'll call it needs analysis, I'm definitely going to charge for that. But if it gets to that level, I've already had a sales conversation to realize it is that degree of engagement. So generally, I don't charge, quote, for the value conversation when it's in a sales context. I certainly would charge for it when it's in the context of a discovery engagement.
That same person comment after you gave that answer, they said, I usually tell them, if I have to look at your numbers, look at your QuickBooks files, if I have to look at your documents, we'll normally set aside at least an hour or 2 hours, enough time for me to do some basic accounting work, right? I will charge for it, but if it's just a phone conversation, which I wouldn't allow to go past an hour, I wouldn't charge for it. You think that's about right?
Yes, because what they're doing is they're setting the scope of what that engagement is. And they've determined that for themselves in advance. So then it's easy to communicate to the customer and say, okay, we've been on the phone for 45 minutes. We need to wrap this up. However, the question you just asked me really falls under a basic discovery engagement. Here's what that looks like, and here's what the price would be. And by the way, I've gotten really good at, in those sales conversations, the first one, if I know I need to do discovery, I right there on the phone tell them we need a discovery engagement, and here's how much it's going to be. I don't even bother writing proposals for those unless when I talk to the customer on the phone, they're receptive to it.
Right. And the last question is, other than your conference you're going to have in November, your podcast, your email, which you're exposing and giving to people just in case they have any questions, or signing up for your newsletter where you give, I think, the in-depth over 7 days of each of the pricing options. Other than that, what books, websites, podcasts, what resources you recommend for people wanting to get deeper and deeper into better pricing?
So I think the first book I would recommend is actually a very quick read. It's not necessarily a book on value pricing per se. In fact, the author doesn't profess strictly value pricing, but it's called the Win Without Pitching Manifesto. You can find it by going to winwithoutpitching.com. Win is in WIN, without pitching. And it's written by Blair Enns. He's actually a consultant and trainer to creative agencies. And the whole idea is that creative agencies have been known for years. In fact, if you ever watched the show Mad Men that used to be on about ad men during the 50s and 60s, they would give away a lot of knowledge in order to try to get the business. And Blair says, hey, we got to turn that up on its end. We got to approach the customers as we are the expert. We are the professional advisor, and they need to pay us for the value that we create, even through conversations. And we're not just going to give away knowledge. And so I think it's a great book to start out with. It's available for free on his website, but I would recommend you order a hardback through Amazon, because you're probably going to want to highlight a lot of stuff. So that would be the first resource I would refer people to.
Awesome, Kirk. Well, once again, thank you very much for attending or presenting in the QB Power Hour. I strongly recommend check out the website, artofvalue.com. Definitely subscribe to the podcast. He's super pleasant to listen to too. I love your microphone. So it's so much better than mine anyway. and I want to go to the conference. I mean, there's a little bit of a conflict with QB Connect, and I may not be able to make both trips. So if you are not going to make it to QB Connect, definitely try to make it to the Art of Value conference in Allen. And Kirk, possibly I'll go there. We'll see where work takes me. There's his email address, and thank you very much. And I'm going to go ahead and wrap up with the last couple of slides. Thank you, Kirk.
You're very welcome.
Okay, so the upcoming episodes, we'll have the next one on August 24th. We don't have a specific topic on it. We're still debating whether or not it's going to be a practice management or a QuickBooks topic. We're getting ready for the release of QuickBooks 2018. And as long as it gets released on the 6th, September 6th, which is Christmas for me, this is Hector Christmas's new version of QuickBooks. As long as it does get released on the 6th, that means that we can talk about it. We'll do a 2-session on QuickBooks 2018. We'll do what's new on the accountant edition of 2018, which is the first one that always gets released. And then on the 21st, 3 weeks later, we'll do a deep dive into all the features that are across all versions of 2018. And then watch out for our website and our Facebook group for possible date changes during October and November, because we have the conferences, we have Thanksgiving, we have October tax season for personal tax return extensions. So definitely check us out for those dates. We'll keep you guys posted. Again, we'd like to thank our sponsors, T-Sheets, #1 rated app in apps.com. Create, manage, and approve timesheets from any device. Aero Workflow, the only workflow management tool for pro advisors, designed by a pro advisor. It integrates with QuickBooks Online. And HubDoc, the most popular document aggregator for QuickBooks Power users. Automate your data collection, bank statement collection, and receipt collection with HubDoc.com. Anyway, thank you very much for attending. Check us out in Facebook. Just type QB Power Hour in your search. Join the group. Continue the conversation. I'm there. Michelle's there. Kirk's there. Ask your questions. Join the community. There's over 4,000 people in that group, and it's very, very active. Also, check out Michelle's LinkedIn group, Successful QuickBooks Consultants. You'll search for that in LinkedIn, and you'll find it. Thank you very much.